Good afternoon. My name's Graeme Smith, and I'm going to talk today about the macroeconomic ratios developed by Wynne Godley and the New Cambridge Research Group at the Cambridge Department of Applied Economics in the 1970s. But the interest is not merely historical. I'll show how these various ratios combine to form a dynamic economic process and how it can illustrate characteristics of modern economies by reference to data on several European economies. Now, there are two separate types of ratios. Firstly, what I've called the flow ratios, and secondly, perhaps better known, are the stock flow ratios. Now, the flow ratios are the fiscal stance, which is the ratio of government expenditure, given the symbol G, to the average tax rate, theta. And the trade ratio is the ratio of exports, given the symbol X, to the average propensity to import, mu. And the trade ratio is actually Harrod's foreign trade multiplier, developed during his work on international trade in the 1930s. Now, the stock flow ratios capture the stock flow consistency condition, that is, that stocks determine flows and that flows update stocks. And any coherent theory of economic dynamics must adequately account for the interactions of stocks and flows. The most common example of a stock flow ratio is the private sector wealth income ratio, which is so important in Godley's dynamics. Now, if a stock flow ratio is roughly constant, or should I say stationary, and I mean stationary in the econometric sense, so not necessarily constant, then it is called a stock flow norm. The point of this paper is to explain that these two sets of ratios combine to form a dynamic process. And this little schematic shows how the dynamic process works. The idea is that G and X, being exogenous variables, act as stimuli through a multiplier process on national income. And that this stimulus, this multiplier effect, is moderated by the stabilizing effect of the stock flow norms. So the appropriate level of income is found by adjusting private sector expenditure and wealth to respect the proportions in the stock flow norm. And this is perhaps best explained by reference to a very high level three-sector model of an economy. The injections into the private sector in the form of G and X are marked here with these heavy red arrows, and the leakages in the form of imports and taxes are shown with these dotted arrows. Now, the normal private expenditure items, consumption and investment, are not visible at this very high level of aggregation. So instead, we have this combined private expenditure term, PX. And notice that PX has no counterpart in any other sector. It's the main endogenous variable in the system. So whatever value PX takes, it determines Y. And so given values for G and X, we can solve for the entire system. Now, if the sectoral balances are zero, we have a stock equilibrium. But if one is non-zero, at least one other must be also, since they must sum to zero. And any imbalances will lead to a flow of financial assets between sectors. Now, the flow ratios actually have two roles. Firstly, as sectoral balance conditions, and secondly, as multipliers. And I already mentioned that the trade ratio is Harrod's foreign trade multiplier. So in the sectoral balance role, the relationship between the flow ratios and national income determines the level of stimulus or constraint on the private sector. And in the case of the public sector, that's these ones here, if the fiscal stance exceeds national income, it's an expansionary situation. since more purchasing power is being injected into the private sector in the form of government expenditure than is being withdrawn in taxes. Also, there's a public sector deficit at this point, so financial assets in the form of government debt are flowing into the private sector. Conversely, where fiscal stance is less than income, it's a contractionary situation, purchasing power is being sucked out of the private sector and financial assets are being drawn into the public sector as it pays down debt. Now, if the fiscal stance is equal to national income, we have a balanced public sector. And similar relationships hold for the foreign sector. Exports in excess of imports is expansionary, and the private sector is acquiring financial assets abroad, and vice versa, where imports exceed exports. But the flow ratios are also multipliers. If there's a step change in one of the exogenous variables, then the increase in Y required to restore a stock equilibrium is proportionally more than the original step change. So, for example, if the tax rate was 0.25, the increase in national income would be 4 times the original change in government expenditure. And finally, the stock flow ratios are the ratios of a stock variable to one of its associated flows, either the inflow or the outflow. And as mentioned earlier, these capture the stock flow consistency condition that stocks determine flows and flows update stocks. Now, in this paper, the concept of a stock flow norm is given a very precise meaning. That is, it is the mean value of a stationary stock flow ratio. So this incorporates the observation that stock flow ratios are often mean reverting, but not constant, and that what they're reverting to is the stock flow norm. Now, as mentioned earlier in the context of the 3-sector model, the variable determining the outcome for the whole system is PX, although it is through changes in private expenditure that the system adapts to changes in the external stimuli, which determines the balance condition of each of the sectors. Now, the new Cambridge hypothesis proposed a functional relationship between PX and disposable income. And this was originally motivated by an empirical observation of a small and stable private sector balance in the preceding period. However, in more recent data, this private sector balance has not been so stable. So the question, does this invalidate the hypothesis? But as shown in the paper, empirical data still shows a strong correlation between PX and YD, so the functional relationship still holds. Now, there have been various studies to estimate the PX function, starting with the original Godley and Cripps paper in 1976. These are studied in more detail in the paper, so I won't go into it here. Godley continued to use the aggregated private expenditure function, and most notably in his prescient 1999 paper, 7 Unsustainable Processes. And from there, it made its way into the Levy Institute model, as described in Zez's 2009 paper. But the form, all of these forms of the PX function contain a term in net lending to the private sector, which in fact is lending by the financial sector to firms and households. So from my point of view, it's a flow within the private sector. And for the purposes of this paper, I'm sticking to this aggregated 3-sector model, at least for now, which only considers flow between sectors. So PX is simply a function of private sector disposable income and financial assets. And from this simple model, we can compute the change in financial assets of the private sector, in whose structure you'll recognize the form of a partial adjustment relation. The term in brackets is the difference between the existing level of financial assets and some proportion of disposable income. And the change in financial assets in the particular period is just some proportion gamma of that difference. So that proportion of disposable income becomes the target level of financial assets. And the ratio, 1 minus beta over gamma, defines the stock flow norm. So it's the stabilizing effect of the stock flow norm is actually a consequence of the form of the PX function. Expenditure is determined by the level of disposable income and existing level of financial assets. And it's those proportions that determine the level of financial assets in relation to income. So that describes all the pieces. How do they combine to form a dynamic process? Well, at a conference in Cambridge in 1983 to mark the centennial of the birth of Keynes, Godley was leading the session on the management of real national income and expenditure, and he explained it in this following passage here, in the context of a two-sector economy. Now, the passage explains that or emphasizes that it is the stock equilibrium condition which ensures convergence. And the stock equilibrium condition in a two-sector model says that the change in government debt must equal the change in private sector financial assets, and that must be zero for a stock equilibrium. And at this point, income is equal to the fiscal stance. So in other words, increasing government debt means increasing financial assets, which increases income through the PX function until the wealth-income ratio is restored. But that was a two-sector economy. What happens in a three-sector economy? Here we have a choice. So which sectoral balance will we converge to? The adjustment still occurs through private expenditure, but which sector is converged to depends on which sector is free to adjust. So in the absence of any other constraints, PX adjusts to balance the private sector under the wealth income norm. So we get convergence to the CFTR. That's this trajectory here. But if there's an economy has a balance of payments constraint, say like described under Thirlwell's law, then income will adjust in order to bring the external balance into adjustment, and we'll get convergence to the trade ratio. So this trajectory here. Equally, if there's a fiscal constraint, as in the German debt brake, then the PX will adjust to balance the public sector, and we will converge to the fiscal stance, as in this trajectory up here. So that gives us a sort of a taxonomy, if you like, of EU economies, or any other economies for that matter, which is determined by the structural relationship between the flow ratios. So if the trade ratio exceeds the fiscal stance, we have a surplus economy. And if in the vice versa situation, we have a deficit economy. And in what follows, I use a red line to indicate the fiscal stance and a green line to indicate the trade ratio. Now, the classic example of a surplus economy is Germany, where the trade ratio consistency exceeds the fiscal stance. And although it was the other way around in the late 90s, that was their sort of sick man of Europe phase. But the 2000s brought the introduction of the euro and the Hartz reforms and launched the present trajectory. So notice the income line consistently tracks the fiscal stance. So the public sector is roughly in balance, and the private sector is acquiring financial assets at the expense of the rest of the world. Conversely, the stereotypical deficit economy is that of the UK, and you can see that the fiscal stance consistently exceeds the trade ratio, and that national income converges to the CFTR, except for this slight aberration at the time of the global financial crisis. So the private sector is running a small surplus, and the public sector and foreign sectors are in permanent deficit, which is called the twin deficit syndrome. The public sector borrowing is being funded partly by the private sector, but mainly by capital inflows from abroad. So a major contributor presumably being inflows into the London property market and the City of London. So here are some examples of some other surplus economies where the trade ratio consistently exceeds the fiscal stance, and that the national income converges to the fiscal stance, leading to a balanced public sector. So Denmark is a classic example. The national income is consistently tracking the fiscal stance. Ireland also has followed a surplus pattern with this major departure at the time of the euro crisis, but it's gradually converging to its traditional pattern. And the Netherlands also is a classic surplus economy, although it took a little longer for them to re-establish that pattern following the financial crisis. Now, some additional deficit economies where the fiscal stance consistently exceeds the trade ratio, so the red line always above the green line, and national income generally converging to the CFTR, so for a private sector balance. Now, France was a surplus economy until the early 2000s, and one wonders whether that has anything to do with the introduction of the euro. It's notable that many of the EU economies changed their pattern at about that time. And Finland was a surplus economy until the financial crisis, when it flipped. And now it seems to be converging towards all three sectors flowing together, so that could lead to a full stock equilibrium. Portugal was more traditional deficit economy pattern, although they seem to be now converging also towards a full stock equilibrium following the euro crisis. Now, finally, here are some that don't exactly fit either pattern. Greece is a special case. Up until the financial crisis, all three sectors were in deficit, with both the public and private sectors borrowing from abroad. Since the euro crisis and their special treatment, they appear to be converging towards an all three balanced sectors situation. Austria has the pattern of a surplus economy, except for its fiscal deficit. So the national income doesn't seem to be converging to the fiscal stance, leaving the public sector in deficit. And finally, Belgium is a deficit economy, at least in recent years, with the fiscal stance above the trade ratio. But the national income doesn't appear to be converging to the CFTR. It's converging to the trade ratio instead. So it's possible that Belgium is following the scenario advocated by Keynes at the Bretton Woods conference, keeping a balanced current account and allowing their own private sector to finance their public sector deficit. So in summary, the objectives of this talk were twofold. Firstly, to explain the existence of this dynamic process formed by the multiplier effect of the flow ratios and the stabilizing effect of the stock flow ratios. And secondly, to illustrate how these combine to form surplus and deficit economies. And the convergence of national income to whichever of the flow ratios is constrained can be demonstrated by simulation, which is done in the paper, and also illustrated by empirical data, which is what we've done here. So the Eurostat data on the selection of EU economies was used to illustrate this classification and to show the dynamic process in action. So thank you.